Let's discuss about the off-balance sheet items. A bank's balance sheet is not just about the assets and liabilities, but it's also about contingent liabilities. And these include the following: letter of credits, letter of undertaking, letter of comforts, and bank guarantees. You can read about all of this in the bank audit, guidance note, appendix for SBA. I think that's chapter 11 as well, as far as I can remember. Uh, ICA has given great uh, guidance on every kind of point regarding this. Non-fund-based facilities are recorded in the books of accounts as a contra item appearing on both sides of the trial balance. So if there is a LC outstanding of 100 rupees, it will also have a debit LC of 100 rupees. So that both are knocked off and there is no impact on the balance sheet. But what it does is increases the size of the balance sheet. It boosts the asset side, it boosts the liability side as well. Again, let's move forward. What you should do is first ask the branch regarding borrower wise and instrument wise list of outstanding items. You should ask the branch, please provide me the list of borrowing, non-fund based borrowings, borrower wise. Okay. This list this list should have the date of expiry, which is very important. The margin required and held. There should be sufficient margin held for all these products. And if there has been any extension of the instrument. What do you mean by date of expiry? By date of expiry, that these instruments usually have a date of expiry according to the contract drawn up. So what the auditor needs to do at the first instance is identify instruments which have expired. What do you mean by expired? The claim period has ended and thus the item should be reversed. What the branches do is they keep these expired items off balance sheet without any problem, and what it does is boosts the asset and liability side total, making the branch look larger in size. Meanwhile, it's not. So again, that's a kind of a distortion, and you should issue an MOC for that. Here's what I found under some RBI regulations. If there is a bank guarantee which is issued for 50,000 or above, it should be it should be authorized and signed by two officials unless lower cutoff. So you can take it as a checklist for verifying bank guarantees. Take a sample of bank guarantees to verify the classification. Now, why is the classification very important? A bank guarantee can be classified into a financial guarantee or a performance guarantee. RBI says you should usually issue financial guarantees. You should not issue performance guarantees usually, because a bank's business is usually financial related, not performance related. We can talk about the differences. Uh, let's talk about the differences. But firstly, why do we care about the classification? The classification is important because incorrect classification will have an impact on the capital adequacy calculation. Why is that? Because both financial guarantees and performance guarantees have different risk asset weight, or whatever it is called. It has a different risk exposure and therefore it has different weights. So we should understand what is the difference between a financial guarantee and a performance guarantee. Let's get on with it. Let me just launch my notepad and find out where is the bank. Black Swan, not Black Swan, that's Audit. Okay, here it is. Why it's not scrolling? What's happening? This app is not working for some reason. Now it's working. Okay, let me find where is it. Here it is. Bank guarantees and financial guarantees. Okay, let's talk about it. Okay, let me just have it. As a general rule, the banks. I want to use just the highlighter. Okay. As a general rule, the bank should confine themselves to only issuing financial guarantees and exercise due caution with regards to performance guarantees. No bank guarantee should normally have a maturity of more than 10 years. This is an important threshold. Banks may evolve a policy on issuance of guarantees beyond 10 years, which is considered appropriate. In general, In general, banks should refrain from issuing non-fund-based facilities on behalf of constituents who do not enjoy credit facilities with them. Basically, what it's trying to say is that if a bank is issuing, if the bank is issuing any non-fund based facility, it should only issue it to its known customers. And this is done because of the KYC checks. This is done because of the KYC checks. Okay, because if a customer walks in and they do not have any exposure with you, you do not know their credibility much, and therefore you would not want to give them a letter of comfort. So yeah. And what is the audit guidance? The first is you should read this circular, review the guarantee bond as per the master circular on guarantees. So every guarantee should have a guarantee bond. Okay, I can have a smaller size of this. Yeah. And when the bank offers guarantee for payment of money in case of a default, it's a financial guarantee, while otherwise it's a performance guarantee. A financial guarantee represents same credit risk as the counterparty. So in this case, what you are facing is the default risk of the borrower. But while we are looking at the performance guarantees, the risk is based on events and not the counterparty. So you are facing a broader risk. So therefore, they both have a different commission and a different risk weight. Financial guarantees have higher commission percentages because of the higher financial risk involved, and hence misclassification can also be deliberate to reduce the commission percentage as well. So there could be an income escaping procedure here. Not income escaping because it's not income tax, but it is bank audit. So what you will call this is hiding their incomes or passing on a benefit to an SSE or a borrower. Let's say. So the summary is like this. The first is the financial guarantees is a direct credit substitute. It has similar risk to a loan, and therefore the credit conversion factor is 100%. While performance guarantees are dependent on contingencies, and therefore they are weighted at 50% in the risk weight capital. Now, these are some examples of financial and performance guarantees which we can refer back in our notes as well. Okay, so financial guarantees have this and this. So some of the examples are given here. Every guarantee given for credit facilities, while performance guarantees could be related to bid bonds, guarantees for financial securities, guarantee for margin requirement with exchanges, mobilization of advances, revenue dues, taxes, duties, credit enhancements, liquid facilities for securitization transaction, acceptance including endorsements, deferred payment guarantees. These are all your financial guarantees. While performance guarantees may be bonds and export performance guarantee in lieu of security deposits, you can look at this. This is very common. Okay, BGs issued for EMDs and guarantees, retention money guarantees and warranties, indemnities, standby letter of credit in relation to transaction. These are performance guarantees. Okay, moving on. If any LC or BG, that is letter of credit, letter of comfort, letter of undertaking, or bank guarantee is invoked, devolved, then the amount needs to be recovered either through the borrower's account, or their current account. You can do is either debit it to their borrower account or debit it to the current account. But make sure that when you are doing the IRAC testing, if any LC or BG has devolved or whatever it's called, if it has been invoked, it shall be considered as a part of the borrower's principal loan account for IRAC. So if a borrower's principal loan is a term loan, then it is part of the term loan. If a borrower's principal loan is a working capital limit, then it's part of the working capital limit for IRAC classification. Refer to this paragraph of the IRAC. Okay.